we're going to move over to a specific name here with Lululemon shares extending losses after the company's holiday outlook disappointing investors. The athletic clothing retailer said it's expecting net revenue to be between $3.14 billion and $3.17 billion for the fourth quarter. That is just shy of the $3.18 billion analysts were looking for there. Still, Lululemon's CFO Megan Frank saying they're pleased with what they're seeing in the holiday season so far. So we're going to break down the kind of discrepancy between those things here with Adrienne Yee, Barclays Consumer Discretionary Senior Analyst. Adrienne, great to speak with you again. Thanks so much for coming on. Talk to me about what I'm missing and what the street might be missing when it comes to this earnings report. The full year guidance not looking great. What are you focusing on?
The entire earnings season for most of the retail sector has really been about positioning going into the earnings. Lululemon is the last of our retailers to report, and the expectations have just gotten more and more heightened as we have gone through earnings. I think that what's important to remember here is the company is guiding to effectively kind of 13-14% top line growth in a holiday season where the National Retail Federation is basically looking for 3 to 4% total growth. So they are well outpacing the overall market, and they're taking share. Their consumers are spending at Lululemon. And remember, they beat the current quarter materially, both on gross margin and all the way through the operating margin as well as sales. They tend to be conservative, right? So this tends to be a conservative management team. They did talk about 2/3 of the holidays still ahead of them.
And so what was also interesting on the call, Adrienne, and always love to get your insights around Lulu as well as the rest of this kind of athleisure landscape right now. It was interesting to hear them mention a younger consumer, and it really was eye-opening for me because a light bulb went off and I had to say to myself, they're not talking about you anymore. They're talking about these Gen Zers out here. So what are they seeing in the spending capacity of that younger consumer cohort, and how do they effectively keep going after them in order to make sure that they're staying kind of in the higher sentiment rankings and continuing to see more of a customer lifetime value and more purchases there?
That is a fantastic point. And that is the point that we have been making kind of throughout the pandemic, past 4 years. During the pandemic and even pre-pandemic, the younger cohort, right, the millennial and then the Gen Z, and I mean, look, the oldest Gen Alpha is 13 years old, right? She's about to step into kind of that buying kind of lifetime value that we talk about. So even though these consumers may not have as much money, right, as their kind of like 30 to 40-year-old counterparts, what they are doing is they are creating such intense loyalty. And one of the biggest cohorts, as you say, that is kind of new to the brand is really kind of that 20-something-year-old kind of fresh out of school. And that's extremely important for the brand. They're doing a fantastic job on social media. They're actually investing in brand awareness advertising because they are still only about 25%, believe it or not, unaided brand awareness in the US. And so these are the types of things that give us such great confidence that they can keep going here. And again, as I said, remember, the stock is up 22% since the last quarter, well outpacing the S&P, the XRT, and any other index that we want to talk about.
Adrienne, while we're talking about the consumers that Lulu is getting it right with, we also got to realize something that they said on the call could perhaps come off to investors as alarming, and that is the fact that in the men's category, they're seeing some trends that are perhaps typical for when there is, at least in the consumer mindset, more of a cautionary environment, and they saw some slippage potentially within the men's that could have a larger ranging kind of implication there. Is that cause for warning, or is this company going to be able to navigate that effectively and make sure that they're continuing to kind of move through with a lot of the kind of touch bases or touch points that they have with men who are purchasing with this company?
Yeah. So the data point that I'll point to there is men's was up 12% during the quarter, women's was up 15%, accessories was up 29%. So not too shabby, but to your point, Calvin McDonald, the CEO, absolutely did point out, he said, look, men in a tougher economic environment may be more judicious with their spending. We know historically, even in the best of times, that men come to the market fewer times. They are more price sensitive and they don't shop as much, right? They do kind of batch shopping, if you will. And so I also think that they came out with a couple of new things, Steady State and Soft Jersey. And then on the women's side, they came out with so many different categories, right? So they are still 75% female driven, and it is something to watch for. And I think the two things, if you were going to really nitpick at the quarter, were kind of slightly below fourth quarter guidance, trying to be conservative, which, by the way, we think they're going to end up beating. And this comment, right? This very frank comment about kind of just general male shopping behavior. I don't think it's something to be alarmed about. I think, when we see kind of a better shopping environment, they are bringing newness. And let's not forget, footwear for men is launching in spring of 2024. So let's see what happens.
Adrienne, one other thing that I noticed a lot in the call was this discontinuing of the Mirror partnership, starting up this Peloton partnership. I know they were draining a little bit of cash on the Mirror product, but Peloton is down 25% year to date. Is that a concern for investors?
It should not be. What I will say sort of diplomatically, I think this is a very graceful exit from, an acquisition that was probably made at the peak of the in-home exercise trend. I think that the greatest thing about this company is that when they see perhaps, investment that maybe wasn't living up to expectations, they quickly change course. And I love that about this management team. They try a lot of different things. That's how you get growth. Some of them will work and maybe some of them will not. This is expected to be less than 5% along with footwear as a component of their 5-year long-range plan. So if you think about it, this is a low single-digit part of the growth strategy to get to north of $12 billion. And so I actually look at it and I say, you know what? They're cleaning up things. They are the singular apparel partner to Peloton, and Peloton will provide their digital content. And I think that's a great way to stay in the mix. But at the end of the day, they sell product, right? They're 99% product business.
All right. Well, they're going to get me on the Peloton platform whenever I see one of the instructors just wearing the rest feel slides, maybe doing a whole workout, because that's what's going to sell me. If it's something I can do in some slippers, then I'll do the workout. Adrienne Yee, thanks so much for taking the time. Always a pleasure to get your insights.
Happy holidays.
Happy
Great
holidays.
to see you.